Good morning and welcome to the KickStart podcast with Joe Breeden and Nicola Firth. Nick's just having a couple of technical issues, so we'll jump into her criteria section when she manages to join us. And I think I've got the pleasure of starting this week and hosting and telling about what an amazing week we had case study-wise. Absolutely, we've seen some amazing trends last week in particular following the previous week's major criteria adjustment within the buy-to-let market. We've actually sourced and stacked quite a lot of really useful products out there, particularly back in the last week when broker demand met sort of lender supply, and a big standout for us last week and our hero lender of the week absolutely was TML, the mortgage lender. Service levels have been impeccable, so if you guys haven't tried them, absolutely do your utmost to speak to those guys right now. And the pricing is really competitive. We placed an 82k loan on Friday, DIP accepted, underwriting progressed, all within the space of 24 hours to valuation. 82k loan at 75% LTV. That was at a rate of 3.29. The property was self-funding, passing rent of 525 a month. So strong covenant, really great to actually push the LTV limits as far as they could go, TML. So well done, guys. There, David Eves and the guys there are absolutely, supporting the broker community in what has been choppy waters, and they're one of the first guys to return that 75% LTV product range, and we're absolutely benefit from that as packages. So if you've got access to them, amazing. If not, speak to us as your specialist mortgage desk, because we do, and we've got packaged rates and prop fees that we can communicate with you about. Bridging, I think that's come a short second behind buy-to-let in terms of institutional demand right now. There seems to be a lot of demand for below market value bridging. Again, we're still trying to work out whether it is actually below market value or whether it's the new normal. But based on pre-COVID-19 estimated values, there are lenders still out there that are willing to consider below market value transactions based on pre-March valuations or pre-March purchase prices, which is absolutely fabulous. And for us, the big standout last week was a funding we completed with MT Finance. They agreed to do 65% of the pre-COVID val, up to 75% of the purchase price. So we had 150k valuation, 130k purchase price, and we did 75% of the 130k. The deal actually came in on Monday last week. We got a value out on Wednesday, which was absolutely fabulous. And the guys there managed to turn it around for funding late on Friday at a rate of 0.89%. So well done there, the boys at MT. Exemplary service throughout this whole period for Crystal and the broker community, and the fact that they're willing to take a view and use a bit of common sense whilst having access to external valuers was something that those guys can be really proud of. I think Nicola is still having a few technical issues, so I have actually been passed her presentation. I've just got to get to grips with how I can, just bear with me 2 seconds whilst I share this with you guys. And I'll talk all things criteria if I can. If not, I'll just read it out to you. In fact, I'll just read it out to you, to be fair. So the weekly criteria summary, 474 criteria changes last week, with the majority again being positive moves. That is down from the previous week. As I suggested earlier on in this conversation, we saw a lot of lenders come back into the market at higher LTVs the week before, where we had 1,086. But still, 474 criteria changes in the positive direction is something we can all find encouraging. And last week for me and sort of for the Knowledge Bank team, felt like the lull before the storm. Skipton, for instance, increasing LTVs to 85%. Lambay today, increasing LTVs on buy-to-let to 75%, allowing large HMOs and MUFBs up to 12 units, and have a new range of new build products. And I think new build's going to be big as well during this period. So if you're not seeking out new build inquiries, then you certainly should be at the moment. I think we spoke to one director of sales at a lender last week, and they seem to intimate to me that 50% of all new build loans completely through the intermediary space, actually go through an ordinary mortgage broker rather than a new build specialist. So lots of opportunity there, and I think it's going to be an area that lenders are happy to lend to. So lenders are regularly communicating their progress with regards to valuation backlogs. That should also be applauded, although we are seeing quite considerable backlogs for some lenders for sure. Team Knowledge Bank's highlights from last week: Virgin Money increased their LTVs back up to 90% on residential, 80% for buy-to-let. Accord increased max loan sizes to 5 million for residential and 1 million on buy-to-let. Principality Building Society reintroduced their joint borrower sole proprietor product. Skipton for intermediaries will now accept income from furloughed workers. That's important, that is. So if you haven't tried the guys at Skipton for intermediaries, definitely add them to your list. A few lenders announced the return of physical valuations as well. So you've got more and more lenders being comfortable with physical vals and working through their value relationships. So you've got Principality Building Society, Pepper Money, Aspen, Breeden and Aldermore added to the ever-growing list on that side. Nottingham for intermediaries increased their LTV back up to 75% on some of their buy-to-let products, including limited company. Gatehouse Bank have increased their buy-to-let LTV from 65 up to 75% and will now lend up to 5 million on buy-to-let and 2.5 million on the home to purchase plan range. Again, great work there from the Gatehouse guys, doing up to 5 mil. Mansfield Building Society are now lending up to 95% on shared ownership. Optimum Credit in the second charge sector have increased their max loan for second charges up to £200,000. So again, some creep in the second charge sector. Habito have recommenced physical vals in England. Pepper Money have increased their LTVs to 75 for Resi and Expat Resi ranges, and their buy-to-let Expat range is now allowed up to 60% LTV on a repayment basis and 50% on interest only. Earl Shilton Building Society, that well-known lender, here she is, reduced their LTV on their first-time bright. Do you want to carry on from here? Can you hear me?
Yes, thank
Nicola's
you. I'm
just
so
joined.
sorry about that. I don't know. Zoom decided to do an update and stop me from getting in. So thank you.
Listen,
Thank you for that, Joe.
No worries. I've just got to the interesting Earl Shilton Build Society criteria. So absolutely, as this is like me being a fish out of water talking about those guys, I'll hand over to you and your.
Well, I'll carry. Thank you, Joe, for that, and apologies, everybody. You've got to love technology when it does its thing, haven't you?
Yeah.
So Earl Shilton Building Society announced last week that with immediate effect they've reduced their LTV on first-time buyer product from 95 down. That was down to 85% loan to value. But then we had Aspen Breeden increase their loan to value to 75%, and they raised their top loan to 3 million. And then we had Roma Finance. They increased their LTV on residential bridging from 65% to 70%, and on semi-commercial cases from 60% to 65%. So just going back as well, before I just carry on with the presentation, Joe did a fantastic job in my absence. I've just made a couple of notes of things I also wanted to tell you as well. So obviously Lands Bay have announced that they're back lending up to 75% loan to value. They've got fixed rates on there from 3.39%, and they've also got a lifetime tracker with no early repayment charges, which is great. And they have resumed physical valuations, which means that all property types are back in the mix as well. And then hot off the press today, we've got Bluestone, who have made a full return to lending. So they originally suspended lending on the 3rd of April, but they're back lending 75% across all credit tiers apart from BBB, where it's 70% loan to value, and they've got a maximum loan of £500,000. So that is absolutely fantastic news from them. And then just a couple of other things as well. The Principality Building Society, so as Joe said, they are back. They've reintroduced their joint borrower sole proprietor. Now that is one of our top searches on for residential brokers on Knowledge Bank, joint borrower sole proprietor. So this is something that is really popular. I think it kind of replaces, when people come in and say, oh, I want somebody to go as a guarantor, and as we know, that's not really a thing anymore. So this kind of has in a way replaced that. So this with Principality Building Society, it allows parents, step parents and grandparents to join their child or grandchildren on the mortgage application, and it includes income affordability assessment for all of them as well. So you can have up to 4 applicants on there, and there isn't a minimum income requirement either, so that's great. And relatives don't need to be on the title deed, so there's no liabilities then from taxation points of view, anything, so they don't own the property. So yeah, that's a really, really good one just to mention. And then just to finish off from me, because Joe did such a fantastic job just on the last slide on the presentation. So we actually made it into the Times on Saturday, and it's just, to be fair, it's the point of what we were talking about that's worth mentioning. So last week we, not criteria related, but we found some emails that were sent out by scammers in what they call a phishing attempt, to try and get you to click on pretending to be the FCA. And they've been targeting brokers and firms as well. So we did send that out in our daily update emails. If you get one of these emails, they do look quite convincing, but if you do get one, then just delete it. Don't open it, don't click on the link, don't click on the attachment. So we did put in our daily email updates what we've seen at the different email addresses they're using. But yes, that did make it into the money section of the Times. So we're hoping we've got that message out to quite a few more brokers now. So yeah, just be careful on that score. So that's it from me. Sorry, that was short and sweet. And thanks again, Joe. Sorry about that.
No problems.
Technology letting us down this morning.
Listen, glad I had to do it this week. Not that, I said to the guys, we're really starting to see the changes from 2 weeks ago sort of work for the pipeline now, and actually lenders delivering on those. And obviously, the first point being 400 odd bits of criteria down from 1,000. Yeah. But again, we think there's going to be another wave, don't we? And I'm pretty confident. Yeah. Once we get the first wave of valuations back in, we'll again see another wave of criteria, and as furlough ends, a further wave. So I think it's moving in the right direction, but in waves.
Yeah, it is, and we're going to see. I think we're going to see a lot of. I honestly do think this is the calm before the storm, because to state the obvious, we've got all the valuations in terms of the Scotland, Northern Ireland and Wales, and we've got to see those come into the fore. And then there's the payment holiday thing as well, because we're expecting the confirmation this week. We actually thought we'd hear it last week, the confirmation about the extension being granted by the FCA and what the terms of that are. But we saw a comment from the chief executive of Nationwide Building Society last week, suggesting that even though they're not being reported to the credit referencing agencies, that they are actually going to look at that. And I did say last week, I put a blog on LinkedIn saying that, we should expect that really. I mean, the first 3 months, maybe let's ignore those, but anybody else who's taking a payment holiday beyond those 3 months, so they're taking an extension, then that's that must be for a reason. So therefore they've maybe got difficulties paying their mortgage. So it's understandable that lenders are going to take a view on that. The only thing I suggested is that maybe it would be good for a good opportunity for maybe the specialist lenders to look at that and look differently at self-employed people. So for example, if a self-employed person hasn't taken a payment holiday at all, then maybe that should be viewed differently as well, because that's a real tick in the box, isn't it? Much more than maybe employed people to some extent. So I think you're right. I think when they make the announcement about the second wave of mortgage payment holidays, and then, as you quite rightly say as well, the furloughed workers scheme, because at the minute we've got pretty clear cut. Lenders are either taking the 80% that the government are giving, or they're saying, right, yeah, we will take the 100% as long as you can evidence you're getting the other the top up, however, from there. But of course, from August, we're going to see that stage top up. So how are lenders going to deal with that? So I think we are bracing ourselves for some quite significant changes with regards to affordability.
Yeah, and Wayne Harrison's just made a point. What are we seeing with regards to lenders' attitude to bounce back loans and CBILS, etc. I mean, all I can say is very, very similar to the furlough income piece. We're being asked the question. And we've been asked the question about all background businesses. So definitely when we're submitting deals, what government support have they had, what shape, and why do they need that? So we're having to build a story around the business support and the justification. And I'm pretty sure any extra financial support that the businesses have taken out will be stressed. I think if you're looking at a short-term loan where there's where there might be servicing for 12 months on some of the bridging products that are available. They might ignore that bounce back because you've got no payments to make for the next 12 months. But then, what happens then in month 13? It's got to enter some sort of a serviceability, income expenditure, plausibility type questionnaire. So the lenders are doing the right thing to ask about those bounce back loans. We haven't actually had any cases declined as a result of them just yet, but I do see it on the horizon.
That's interesting as well, because one of the we've seen that as well, and we're going to start to add some new criteria categories on Knowledge Bank around that, because we know that so brokers are asking, and they're asking because their clients are asking, and one of the questions that we've seen asked on both residential and buy-to-let cases is, can they use the bounce back loans as deposits and things like that. So yeah. Your instinct would be, well, no, but then you have cases like, for example, there are a few lenders that like Barclays, for example, they will allow on a normal residential mortgage, they'll allow the deposit to be borrowed. They'll allow a personal loan for the deposit, and without the requirement to put any of your own money in. So it's not a well-known piece of criteria, but it is there. So we can't necessarily assume. I mean, we can say morally, is that right? Perhaps not, but and then of course you've got buy-to-lets where you might have businesses that are investing in premises, and commercial as well, where they're investing in premises. So then is that completely legit? A lender's going to be happy with that? So lots of questions around those, I think. I don't
think they'll be, so my personal opinion on that one, Wayne, is, I don't think that they will be rejected. Because you had the loan, it won't necessarily, mean that you're going to reject it. Never mind if you then use it for the property transaction. I think it all comes down to affordability, right? And responsible lending. And if you can afford that loan, then I think the lender will support the application. We've been doing deals for years and years and years where someone's raised a second charge or cap raise against their own income property to provide a deposit. We've had to let the lender know about the details regarding that loan, and that even if it hasn't yet completed, the lender wants to factor that into their affordability count. That's a responsible thing to do, and I see that being the case moving forwards.
Yeah, no, I would agree. I think we've got some interesting bits of criteria that we're going to ask, and I think certainly from our point of view, we'll over the next week or so you'll see quite a lot more categories on Knowledge Bank. But we've
just remember the bank. Sorry.
No, go for it, Joe. You're right.
Just remember the bank statements reveal all. That's all I say. I think for me, even if they don't ask you the question day one, is it a lender that's asking for personal and business bank statements or either or? What are they looking for? So just bear that in mind.
Yeah, you're absolutely right, and that's what we were saying. Last week, that the fact that there was quite a big deal made about these payment holidays, saying that they wouldn't be reported into credit referencing agencies, and that's absolutely true. However, that doesn't mean to say they're not discoverable. And in the underwriting process, when they're looking at bank statements, they don't even need bank statements. For the lenders who use open banking, they can quite clearly see the mortgage payment for most people is the biggest payment coming out each month of their bank accounts. If that's not there, then that tells its own story. And as I say, whilst I think the 3 months, the initial payment holidays will be waived through, I think it's the ones that come after the extensions to the 3 months that we need to be careful of, I think.
Yeah, I agree with that. And I think as well, again, something else that might be interesting for the guys moving forwards would be about part payments, because I'm hearing a lot more from lenders about then the customers not having a total payment holiday. Perhaps what they're doing is 50-60%, and does that affect any of the I guess their ability to lend in the future? I don't know. It's something we'll just have to keep an eye on and feedback to the guys.
Yeah. Yeah, definitely. Well, at least doing this every week, then we literally are getting a week by week picture of what's happening and what's changing. So we will be keeping an eye on that, because we do expect that announcement this week. And I think lenders will react pretty quickly to that, because obviously payment holidays is a big thing for lenders to administer it, to fund it. So I think that they'll be looking then at their books going forward. So we'll definitely bring you more on that over the coming weeks, definitely.
Great. Any more questions, or are we done?
Yeah, I think we might be done this week.
Bounce back out of here. That's what we've done.
Yeah.
Right, brilliant. Well, listen, stay safe all, and we'll catch you next week.
Thanks again, Joe. Thanks, everybody.
No problems. Be safe. Bye.